A very good evening to everyone. We shall be covering commodity options and commodity options trading today. We have been hearing about, before I get into commodity, what are options, how the commodity options are to be traded, what are the do's and the don'ts and the basics. We've been all hearing about commodity options for many years. But finally, it seems that the light of the day is more or less approaching, and within a couple of months, ideally, we should have commodity options trading on the exchanges, on the commodity exchanges. So, how we structure this webinar is that I will be uh, telling what are the different types of options. I'll be giving you examples with regard to Nifty and also with regard to gold. If gold were to trade as an option, then what are the ways you can trade? Also, I'll be talking about on the Greeks, some bit on the Greeks, what you should do, what you should not do, and how you can trade successfully once options comes. And going forward, you can also write to us for your queries, and we will help you in that regard. So first of all, we talk about the options. So options are, all of you must be aware about futures, because commodities in commodity markets currently we are having only futures contracts. So you simply buy a futures or you sell a futures, and there, if the market opens with an up gap or down gap, the risk can be significantly more. But in options, you have that advantage, because under the derivative segment, you have both the futures and the options. Likewise, if you look at the equities market, you have the futures and the options. If you look at the currencies market, you have the futures and the options. Options is in the USD INR though. And if you look at commodities, commodities still are futures. So, but now with the likelihood of implementation of options also, or introduction of options also going forward, that would be a big leap for the commodity markets and also for the market participants, because options are a different tool altogether. So I will be explaining to you how you can take advantage of that. So generally, options by the word itself refers that it's not an obligation. So you have any trade to happen has to have a buyer and a seller. Seller, then only the trade gets executed. So what happens here is that in terms of options, there are two types of options. You have a call option and a put option. So if you are bullish on the market, then you will, if you are buying of options, so you will be buying a call option. But if you are bearish on the market, so you will be buying a put option. So options are contracts that gives the buyer the right, but not the obligation to buy or sell a specified underlying at a set price on or before a specified date. So we'll take examples, so this will be clear. Just you need to understand here is that basically options are two types, a call option and a put option. So if you are bullish on the market, you will buy a call option, and if you are bearish on the market, you will buy a put option. But as I said earlier, that for any trade to happen, for any buyer, there has to be a seller. So if you are buying a call option, that means you are bullish. So someone who's on the sell side of option, that is selling that call option, is bearish, who's also called a writing of options. Likewise, when you buy a put option, that means you are bearish on the market, that is you expect the market to go down. But when you are buying a put option, someone on the other side, someone on the other side has to have a writing or a sell of that put option. So he will be more or less on the he will be more or less I would say on the uh, buy side. So buying a call option means bullish. Buying a call option means being bullish, whereas buying a put option means bearish. So a call option is a contract that gives the owner of the call option the right, but not the obligation to buy the underlying asset. So if you are buying a call option, you generally have to pay a premium. We'll talk about that as well. What is that, how that is calculated, and so generally what you need to understand here is that if you are buying a call option and the market is moving in your favor, so you pay a premium. So you, that premium is the maximum risk that you face. Unlike in the futures contracts, what happens is that your risk can be unlimited, in the sense that the market, you say for example you buy gold at 30,000 and next day gold opens at 29,700. So there is a 300 rupee fall which is there, and you had, say for example, put a stop loss at 29,900 and you had bought at 30,000. So your stop loss does not get triggered the next day. So earlier you were anticipating that you will take a maximum loss of only 100 rupees. So you have bought a 1 kg gold, so effectively it is 100 rupees multiplied by 100, so you have a 10,000 risk. But the market next day gaps down only at 29,700. So your loss is not 10,000 which you thought, your loss is now 30,000. So because you have a 300 point risk and multiplied by 100 is 30,000. But that is the beauty of options. So say for example, in this case you had paid a premium of 100 and the lot size is say 100, so you had paid a amount of 10,000 to buy this call option. Now if next day the gold, for example, gold fell from 30,000 to 29,700, the maximum that you will lose is 10,000. It will not exceed that level, exceed that. So that is the beauty and the advantage of options, which is not there in futures. But again, that there are limitations also in options. I will be talking about them as well, as to if you have this significant advantage, then what is the disadvantage. So generally when you are bullish on the market, and the way you look at options is that it is the same irrespective of whichever asset class you trade. If you are trading equities, if you are trading nifty options, if you are trading currency options, and going forward if you trade gold options, so they are more or less the specifications would be different, but the way the option is there and the logic remains the same. The underlying in this case would be different. In Nifty futures, the underlying would be Nifty. In Nifty options, the underlying would be Nifty. In currency options, the underlying would be currency, and in commodity options, the underlying would be commodity. So you have this advantage of buying a call option by paying a premium, so that is your maximum risk. Likewise, if you are bearish on the market, you feel that gold is likely to correct from 30,000 levels, so you can buy a put option. So in that case, you buy a put option and you pay a premium of say 100 rupees in this case. So if gold prices fall, so the value of your premium increases. But suppose gold prices starts rising from 30,000 goes to 30,100, 200, 300. So the value of your premium, that is the put premium, falls because you were expecting or anticipating that the market will correct. But the market, that is gold prices, have not corrected, rather they have started going up. So clearly that shows that you will be losing money on this particular trade because it is not going in your favor. But the maximum risk in this case is also 10,000 rupees because that is the maximum premium that you have paid. So you look at any example and be it a Nifty index or a gold option or a currency option, they all we trade the same way. It's only the underlying which is different and the contract specification is different. And there are generally two types of options. You have American style option and the European style option. So the buyer of an option in an American style option, what happens is that the buyer of the option can choose to exercise his option at any given period of time between the purchase date and the expiry date. So the person who's buying an option, he can choose his expiry date, exercise date on any day between his purchase date and his expiration date. Whereas in the case of European style options, the buyer of the option can exercise his option only on the expiry date. So it will only on the expiry date, and generally most of the options are European style options. So that is also what we will be having in the commodities space, just like we have in the equities and the currencies. So the premium paid to buy an American style option is normally equal to or greater than the European style option for the same underlying, because in the American style option you can exercise your option at any given period of time between the purchase date and the expiry date, whereas in the European style option you can exercise your option only on the expiry date. We just take a look here. I have purposely used a Nifty example because we don't have any commodity options right now. I have commodity option examples also, but I'm just putting a Nifty example to make things even clear to you. So say for example you buy a Nifty 8,900 call. That's a September call at 97.50, and you pay a premium. So the lot size, you need to know what is the lot size of the contract. So in this case of Nifty, the lot size is 75. So what you find is that you pay a premium. So the premium that you see is for single unit. So you have to multiply that by the lot size. So in this case it is 97.15 into 75. So the total premium that you pay is 7,286. Now, and you are buying a 8,900 strike price. What happens in options? In futures it is very simple. You have a July futures, you have a August futures, you have a September futures, but in options you have the July series and the August series and the September series and so forth. But again in the series you have different strike prices. So each option would have each I would say commodity would have its own variance of difference of strike prices. So say for example in Nifty it's a 50 point change. So it will be 7,000, 8,900, then 8,950, then 9,000 strike, then 9,050. So when the contracts come for the commodities, that also will be mentioned as to what the strikes are going to be. So in gold it could be either 50 rupees or it could be 100 rupees for the strike difference. Likewise, so what we see is that you need to understand what is the strike price, and secondly you also need to understand what is the lot size. So in this case the lot size is 75. So that's the maximum premium that you pay. Now from Nifty, suppose trades higher and moves higher. So in this case the value of your option, you had bought it at 97 rupees 15 paise. Now that has increased to 137 rupees because the market, you have bought a call option and the market is going up, so you are making money. So the profit here is 40 into 75, that is 3,000 rupees. Whereas in the case that the Nifty falls, that the market does not go up and Nifty corrects, so in that case you have a loss of 2,250. In this case Nifty trades lower to 8,800. So you can just replace the Nifty with gold. So for example, gold is trading at 30,000, you buy a gold call option and with a strike price, and you pay a premium of 100. So if gold moves up, starts moving from 30,000 to 30,100, 200, 300, so you'll find that the value of your option also increases. So you can book your profit anytime, whenever you want. That is entirely up to you. Likewise, if the when you buy a call option and the market moves against you, that is gold starts moving down from 30,000 to 29,900, 28,000, 29,800 and so forth, then the value of your call option will start declining, so you will have a loss. So likewise, but had you bought a put option and the market is going down, you would have made money. So that's the reason you have calls and puts, and you can use them to your advantage. Generally what happens is that there's something which is called in the money, at the money and out of money. So you need to understand that in the money options are where the market price of the underlying asset is more than your strike price. So you will find that that is in the money, and at the money is where the market price of the underlying asset is the same as your strike price. So say for example, if gold is trading at 30,000 and the strike price is 29,800, so that is in the money. But if gold is trading at 30,000 and the strike price is 30,100, 200, that is out of money. So you can, and this is for a call option. So the reverse will be for a put option. These are very simple things to understand. Once you understand them, you will find it very easy. And believe me, once you start trading options, you will find that it's far comparatively far safer as compared to futures. It has its own, I would say, challenges also, which I'll be talking about how you can address them, and at the same time how you can take advantage. Also, using options, you can formulate strategies using futures and a combination of options or options itself. I'll be touching on some briefly on some of the strategies as well. So generally there are something called options Greeks. That's a term which is used, and in this I'll be talking about the two most popular ones. We have many, but I'll be talking about delta and theta. So generally what happens is that the underlying, say for example, you find that the gold is moving up, gold is moving up by 100 rupees. Gold prices have moved up by 100 rupees, but your option, say from 100 rupees it has gone to only, say gold has gone up from 30,000 to 30,100, but you're finding that your option has moved up from 100, it has gone up to only 130 or 140. So had you bought a futures contract, you would have made a profit of 100 points. But in these options, you are finding that you are making a profit only of 30, 40 or 50, depending upon what type of option you are buying, whether you are buying out of money, at the money or in the money. So that is where the delta comes in. So the delta is the rate of change of the price of the option with respect to the underlying securities price. It's very simple. What it effectively means is that if the underlying security is moving up by one point, then the option will move up by it, and that is expressed in percentage. So not in percentage, in decimal. So it could be 0.3, 0.4, 0.5, or it could be 0.8, 0.9, depending upon whether it is deep in the money uh, or at the money or out of money. So you find that for far out of money options have delta value close to 0, while deep in the money options have deltas that are close to 1. So deltas which is close to 1, what it means is that more or less it will change exactly as per the underlying. So it is more or less, it will behave just like a futures contract. But what happens is that when you are buying a deep in the money option, you have to pay a very high premium. So somewhere or the other, and if you are buying deep out of money option, you will pay a very minuscule premium, but the probability and the possibility of making money reduces significantly. So you need to know which are the strikes that you should actively trade in. I'll be talking about that as well, because that's from a practical perspective which can help you. And generally what happens is that you find that if just to take an example, so if a delta is 0.6, it means that for one positive move in the underlying value, the call option will move by 0.6 points. And passage of time and its effect on delta. As the time remaining to expiration grows shorter, the time value of the option evaporates and corresponding the delta of in the money option increases, while the delta of out of money option decreases. So generally what happens, you also have to look at the expiry, when is the contract expiring, and when you want to buy it, how long you want to hold it. Generally what we have seen is that those who are buying options, they buy a call option or a put option and then keep on holding till expiry. That is not a very good way to trade options. You need to understand that there is something called theta also which comes into play. Just as delta is important, delta represents a change, a rate of change in relation to the underlying change. So if the underlying is moving up by 100, and if the delta of that option is 0.5, so that means that option will move up by 50 points. So that's delta. And the next is theta. So theta again is very important, because this delta and theta do not apply for the futures, because it will move as is. If but in options these are the challenges. So the advantage is that you pay a very small amount, so you can leverage significantly. Secondly, if you are on the buying side of options, either a call option or a put option, your risk, you know what is the maximum possible risk that can happen in at any given point of time, because if you're buying of options, the premium that you pay is the full and final risk that you take. But the flip side is that you say, for example, you buy a gold option contract at say 30,000 when gold is trading, and you bought the option at say 100. Now gold does not go anywhere for the next couple of days. It's trading between 30,000 and 30,050 or 60. 30,050 or 60. So in that case, you will find that the value of your option is declining. So from 100 it could become 90, it could become 85. But had you bought on the futures, gold futures, so even if gold were trading at 30,000, 30,000. So if gold were trading at 30,050, in that case you would अब वाईफाई में सही करते हैं वो कहीं वही हाँ वही है कनेक्टेड तो है रीएस्टैब्लिश तो हो गया So we had some technical issue, so I think that's got resolved now. So what I was saying is that if we look at the theta, so in this case, yeah. So if we look at theta, in this case, the gold option is not, you're not making money because gold has moved up from 30,000 to 30,050. So had you bought a futures contract, you would have gained 50 rupees. But in options, if gold is gone up by 50 rupees, but in 2-3 days, you will find that the value of your option premium has declined from 100, it could come down to 95, 90, depending upon what is the delta and what is the theta of that particular option. So this brings out a very important point that whenever you are trading options, irrespective whether you're trading commodity options or equity options or currency options, you need to understand that if you're buying an option and if you're holding it for very long and you're not making money, then the probability and possibility of your making money reduces significantly, because both the delta and the theta, they are working against you. Every passing day will make it all the more difficult for you to make money. So whenever you are trading in options, you need to understand that it is from a short-term perspective. Within a day, 2-3 days, if you are out of your position, you are better off. Because what we see is that majority of the people, if they are on the buying side of option, they will just buy the option, be it a call option or a put option, and then they will wait till expiry, expecting that they will make money, but they will find that to their surprise that even if the market has gone up in their favor or gold has gone up in their favor, still the value of the option has fallen significantly, so they are in loss. So this is so what we see is that theta becomes very important when we are trading options. Then there is something which is called the intrinsic value. Intrinsic value and the time value. Time value I have already stated. So intrinsic value is generally the difference between the strike price and the current market price. We'll just take an example here of Nifty, so you will understand even better. that an option premium which you pay is basically made up of two things. One is the intrinsic value and the second is the time value. So and the intrinsic value is the difference between the strike price and the current market price. So if you look at the first column where the it is the 8,100 call option, and so the premium is 340. So in this case, and you see that the value of the futures is 8,400. So the call option is 8,100. So what is the intrinsic value? That is the value of 8,400 minus 8,100. So your intrinsic value is 300. So what remains is your time value. So the total premium you paid is 340. So 340 minus 300, that is equal to time value, that is 40. So you will find that intrinsic value is always found in the money options. Out of money options, they have zero intrinsic value. So if you look at the 8500, if you look at the 8500 call option, 8600 call option, 8700 call option, here the intrinsic value is 0. Even the 8400 call option, the intrinsic value is 0, because for the 8400 call option, the future is also 8400. So 8400 minus 8400, you got 0. So all the out of money OTM, that is called out of money options, their intrinsic value is 0. So what remains is the time value. Likewise, you have for the put option. So put option, if you see that all the options which are greater than the futures price, there they have the intrinsic value. So 8,400, 8,500, 8,600, 8,700, they have their respective intrinsic values. Whereas the below ones, like and the equal one also, like 8,400, 8,300, 8,200, they have zero intrinsic value, and what is the premium is the time value. So this is something which you need to understand. We'll just take an example here, which will make things even easy for you. That Harish, there are two persons. One is Harish, who basically invests and trades in gold futures. So he buys gold when gold is at 30,000 levels. Now Manish, he trades in options, and he's bullish on the market, and he has bought a gold call option by paying a premium of 100 for a 30,000. Say the strike price in this case, we've just taken it to be 30,000. Now what happens if the market falls by 100 points? So in this case, we assume that the lot size is 100. So Harish in this case loses 100 because the price has come down from 30,000 to 29,000 to 29,900. So he's losing 100. And since the market lot size is 100, so he's losing 10,000 rupees. Whereas Manish, who has bought an option, he is losing 100 into 65. That is 6,500 rupees. Why? Because in this case, the delta of this option contract is 0.65. So for every 1 rupee movement in the futures, the equivalent movement in options happens. So it moves by 0.65. So it is 100 into 0.65 into 100. So you have Manish loses 6,500. Other way you look at it is that if from 30,000 it falls to 29,700. So in this case, Harish would be losing 30,000. But Manish's maximum loss is restricted to 10,000 only if the value of the option becomes 0. So that is the advantage and the beauty of options. But as I said, that just buying an option and holding it like a lottery ticket is not a good idea. If you hold for a long period of time, the time decay will eat your option premium, and at the end of the day, you'll find that even the market has moved up because of the passage of so many days, every day you need to remember that every day, every hour, the value of your premium is decreasing. So you have to act fast when you are on the buying side of options. Unfortunately, most people who trade options, they treat it like a lottery ticket. So once they buy an option, they hold it till expiry, and then they realize, okay, they have lost money. So that's not a good idea. Now, earlier example we had taken was that gold prices had moved down, so they had incurred a loss. The flip side is that gold prices rises by 100 points. So in this case, Harish So because he's trading in futures, so the margin is also higher. So you would just assume that he's trading gold futures with a margin of say 50,000. So in on the margin of 50,000, he's made a profit of 10,000. So that's a 20% return on investment. Whereas in options, Manish has gained 6,500. So the investment that Manish had made was 10,000. So he's got a return of 65%. So you can see for yourself that option gives you amazing leverage. But options has its own, I would not say risk per se. If you see what is risk, risk is something if you really don't understand. But if you understand, then you can trade accordingly. It's just like those who are driving racing cars. They understand the risks of the game, but they are well prepared and they are also well trained. So, and they also have the knowledge. So the same applies to each and everyone who's in the markets. So buying options minimizes risk while at the same time maximizes returns. So it's all a game of timing in the market. So you need to understand that is just buying an option, call option or a put option and holding it is not the right way. You need to get out or whenever you're making a profit or incurring a loss, or if the market is not going in your favor, whatever premium you can save, you should save. It is not that once you have paid a premium, so you will say or feel that no, I will hold on to till the expiry and I will see what happens. That's not a good idea. Ideally, you should keep a 1, 2, 3 sort of rule. Either the market moves in your favor in the first day, second day, or the third day, or you are out. So you should have some of the rules which is there, which suits you. Now we'll just look at that in options and futures. We have the open interest also plays a very important role. So if you find that the price of gold is rising, volume is also rising, and open interest is also rising, so that basically reflects a strong market. Likewise, if you find that the price is rising but volume is falling and open interest is falling, so that means that now the bulls are losing control, so there is possibility of a trend reversal. Likewise, if prices are falling but volume is rising and open interest is rising, so in this case what it means is that the market is weak and further we could see selling pressure in the market. Whereas if price is falling but volume is also falling and open interest is also falling, so that means that now sellers are less confident of selling at lower levels, so there is a possibility of a trend reversal. So what my suggestion to all of you on the webinar is that you should also look at the open interest. You should also look at the volume. That will also give a clue as to which options contract you should trade. Do not trade illiquid options contract just because you find that they are very cheap. There's nothing called cheap or expensive. It is all relative. That is something which you need to understand. So there are different strategies. I'll talk about a couple of them. You have one is that you can buy options to protect your futures contract, so that which is called synthetics. So in this case, you have a gold futures position. So that means you are long in gold futures, but there's some event or something which is likely to happen. You don't know, maybe the market could correct. So rather than exiting your position, you can buy a put option. So if in case the market moves down, you will make money on your put option, but you will lose money on your futures. So net net, you will not be losing much. So this is one way of using options. It's very good for those who want to trade. And also, if you are short in futures, that means you are on the bearish side of the market. But if you feel that maybe some news is going to happen or some international event is going to happen, the market could open with an up gap tomorrow, and you really don't want to exit your position. So in that case, you can buy a call option and then you can hold your position. So it is very helpful during volatile times and can help you protect your downside. So as I said, using calls and puts when you are having futures position is also a very good way of looking at it. Then this is something called covered option writing. Basically, in this case, what happens is that in the earlier case, we saw that you were buying an option. That means you were buying a call option or a put option. In this case, what you do is that you are long in futures, so you are bullish on the market. So rather than buying a put option, you are selling a call option, because you need to understand two things. That if you are buying a call option, so you are bullish on the market. But if someone is selling a call option, then naturally he is bearish on the market. Likewise, if you are buying a put option, means you are bearish on the market. But if someone is selling a put option, that means he is bullish on the market. So covered option writing basically means is that if you have bought futures, then you will sell a call option. And likewise, if you are short futures, that means you are bearish on the market, then you will sell a put option, because selling a put option is equivalent to buying a call option. But generally when you sell a put option, you get the premium. When you are buying an option, you have to pay premium, but when you are selling an option, you get premium. So that premium can stay with you provided the market doesn't move against you. So this strategy can allow you to take advantage of the high option premiums, but it is less risky in a volatile market. The disadvantage is that the most you can make is only the premium. Then there are other types of strategies which are there. There's something called the straddle, and we'll just look at that. So these are option strategies. Earlier we had talked about that either you're bullish on the market, you're bearish on the market, so you buy a call option or a put option. In this strategy, which is called a straddle, you are buying both a call option and a put option at the same strike price. So what it means is that why now the big question is, why would you do this? Generally you would want to do this if you know that maybe tomorrow some major event is, you are aware that something major is going to happen tomorrow. So either the market is going to go up significantly or correct significantly. So in this case you can buy a straddle. So what you do with this, you buy the same strike call and the same strike put. So you are paying premium twice. That is, for a call option you are paying premium, and for a put option you are paying premium. Next day the market, there is extreme volatility and one-sided the market starts moving. So what will happen, and the market starts moving up. So what you will find that your value of your call option starts increasing, but the value of your put option starts decreasing. So maybe you will get an opportunity to exit with a decent profit. So you have to look at it from that perspective. So generally when you are buying a straddle, if the market is extremely volatile, you stand a chance. Those who are on the sell side of the straddle, they are more comfortable if the market is in a range. Then there is something which is called a strangle. This is again like a straddle only, but in this case the strike price, what we saw in the straddle is, let's say for example, just to give you an example, we'll take gold, that suppose you have a gold option and 30,000 strike price call option. So what you do in a straddle is a 30,000, you buy a 30,000 strike price call option also, and a 30,000 strike price put option also. So that is a straddle. But a strangle, what is a strangle? In this case, if you buy a 30,000 call option, you could say buy a 30,100 put option or a 29,900 put option or whatever. So in the strangle, your strike prices are not the same. Now, so there are some winning rules for trading options. This is something which is very important, and I would request all of you to pay attention here, is that you need to stay away from deep in the money options. Options which are deep in the money, you will find that they are you have to pay a significant premium. So that's not a good idea. So you should keep away from deep in the money of options, and also you should keep away from deep out of money options. How do you understand? It's very simple. Just to give you an example, if say gold futures is trading at 30,000, and so you will find that all options which are below 30,000, they are in the money. And say for example at 29,500, that's deep in the money. 29,000 is even deeper in the money. But the moment options goes above 30,000, 30,100, 200, they are out of money. So you'll find that a 30,500 call option is deep out of money. So deep out of money call options, they are very cheap. Deep out of put option money, they are very cheap. Deep in the call money options, they are very expensive. Deep in the money put options, they are very expensive. So you should avoid both of them. You should not, because what happens is that you feel that, okay, I will buy a 30,300 or 30,500 call option, whereas the gold futures is at 30,000. So you pay a premium of say only 20 rupees. So you'll say, oh, I'm paying a premium of only 20 rupees, and just assume that the lot size is 100. So effectively what it means is that you have taken a risk of 2,000 rupees. 20 into 100 is 2,000. Now in that case what happens is that because you've bought a call option with a strike price of 30,500, the possibility of the market reaching there is very remote. So net you will lose that 2000. So the next question is, what strikes do you then exactly buy? So in this case, you should trade slightly out of money, at the money, or slightly in the money options. So if gold is at 30,000 and the strikes are of 100, so the next would be 30,100, 30,200, or below would be 29,900, 29,800. So either you whatever the current futures price, you should trade two strikes above or two strikes below. That's the range you should take, because you'll find that maximum liquidity and volume is also in those strikes. Also, what you need to look at is the open interest. You can get all this data, so you should look at which are the most active contracts. You should trade only those contracts. The advantage is the bid and ask spread is also low, so getting in and getting out is also easy. So what happens is that you buy a cheap option, so in that case you pay a low premium, but the bid and ask spread is high. So you have bought at 20, but when you want to sell it, maybe it's gold has gone up, but now someone is willing to buy only at 17 rupees or at 15 rupees. So even gold going up, the bid and ask spread is significant. So you need to look at a couple of things. One is the bid and ask spread. What is that? Secondly, what is the open interest and volume? Which are the major contracts where you have in options which have the maximum open interest and volumes? Those are the contracts that you should trade. And generally, they should be very close, 2 to 3 strikes on the out of money side or in the money side. And then there is a time for all seasons. Options gives you the advantage that you can have different strategies. We will cover that also going forward in one of the webinars as to what all different strategies are there. But let's go one at a time. And believe me, options are excellent tools to trade, and excellent opportunities can be made. Like we see in Nifty, in Bank Nifty. In Bank Nifty, you have Bank Nifty weekly options as well, which are very popular. So you can definitely trade positively on the options, but you need to increase your knowledge. And also, as I said, just don't buy and hold it as a lottery ticket till the end of expiry. That's definitely not the right way of trading options. We just look at a few precautions as to what you should do is that always trade with stop loss. When you're trading futures, your stop loss might not get triggered because the market could open with the up gap or down gap. But in options, your maximum risk, there also you should be clear as to do you want to risk the entire premium or do you want to get out. So but in that case, ideal way to put the stop loss is to look at the futures contract, because options, as I said, the time decay, and the time decay will kill the premium. So you need to have your stop losses as per the futures. Then never average a losing trade. If you're in a losing position, don't average a losing position. And as the option nears the expiry, the value of the option reduces due to time decay. This I've already explained. And losses are limited in buying of options in comparison to selling of options. So say for example, gold is at 30,000 and you are buying a gold contract with an option of by paying a premium of 100 rupees. So now gold starts moving up, so your premium becomes 100, becomes 150, 200, 250, 300. So you're making a decent amount of money on your trade. But if the market moves against you, so the maximum risk that you have is 100 rupees. Whereas when you are buying an option, call option by paying a premium of 100, there is someone who's selling that strike price and getting that premium of 100. But if he does not have an exit strategy or a risk management strategy, he could end up selling at 100 and buying it back at 300. So he could have a huge loss. That's why selling of options carries unlimited risk, whereas buying of options carries limited risk. So selling of options is more like your futures. Always prefer to take a view in options closer to the market. So these were the major points which I wanted to cover on the commodity options. So we can have your questions now.